Okay, everyone, Assalamu alaikum in today's session, and welcome to SBR Practice to Pass Day 2. Till yesterday, we had solved the areas of piecemeal acquisition and the disposal. So, in case of consolidation, there are step acquisition, the important areas, disposal, and foreign subsidiary. So, these are mainly three areas that we had to discuss, and the next area was the statement of cash flows. So we have done these two till yesterday. Today we'll be solving these two one. And then if we have more time, we will be moving towards the area of ethics. So we are going to solve two questions, one by the name of Rose and one by the name of Bubble. One is June 2011 attempt and one is December 2015 attempt. So let's start. You people would have received the files of these questions. So I'm moving towards my files. This is the question of Rose. This is June 2011 question, and we're going to solve this. Okay, so the question says that Rose, a public limited company, operates in the mining sector, and the draft statement of financial position are as follows. So we have a company Rose, which is the parent company. We have a company Petal, which is the subsidiary company, and we have another company STEM, which is the foreign subsidiary. Now the question says that the investment in subsidiary includes the Petal and the STEM. Now in SBR, you should expect that the question would have already prepared the consolidated financials, but they would be incorrect. So the question is going to ask you to re-prepare or to calculate the values that would have been or should have been according to the correct treatment. So now the investment in STEM has been calculated as 46. So we'll be talking about the STEM mainly because this is the foreign subsidiary. So in case of foreign subsidiary, what do we do? That we prepare a working number one that relates to the net assets. And in this net assets, we have two column net assets at acquisition and net assets at the balance sheet date, where we basically write all of the equity items because the word net assets is total assets minus the total liabilities, which is actually equals to the total equity. So we calculate the net assets by calculating the total equity. So if I go back to the question and look at the equity section, the question has given us these three values: the share capital, the retained earnings, and the other components of equity. And the values of STEM are basically 200, 300, and 0. So Harsh is asking what is at balance sheet. Harsh, you are going to understand this. So I'm writing share capital and retained earnings and the other components of equity. So the share capital, the retained earnings, and the other components of equity, these values are how much? 200, 300, and 0. So at balance sheet date, the share capital is 200. At balance sheet, the retained earnings are 300. And at balance sheet, the other components of equity are 0. So we are going to write the net assets at the balance sheet over here. Harsh, are you getting this? And similarly, the share capital at acquisition was the same 200, but the retained earnings in the OCE will be informed by the question. So let's go back and read the question. The first part of the question mainly relates to the local subsidiary, which was Petal. So we are not talking about Petal. You can try this at your home on your own. So our focus is mainly on the foreign subsidiary, which is the STEM. So the question says that Rose acquired 52% of the ordinary shares of STEM on 1st May 2010, when STEM's retained earnings were 220 million dinars. So we are going to write 220 million dinars over here because these are the retained earnings at the date of acquisition. The fair value of the identifiable net assets of STEM on 1st May 2010 was 495 million dinars. Now the question is given as the fair value of net assets as 495 million dinars. But if we calculate the carrying amount of the net assets, which is the sum of all these, we're going to get a value of 420 million dinars. This means that there is a fair value adjustment required by what amount? By the remaining amount of $75 million dinars. So we're going to write a fair value adjustment over here by 75 million dinars. And we need to see to which item does this fair value adjustment basically relates. So the question says that the excess of the fair value over the net assets of STEM is due to an increase in the value of land. So this means if it is land, the same value is going to be there at the balance sheet date as well. And the OC is so far 0. And the further question says that the fair value of the non-controlling interest in STEM at 1st May 2010 was 250 million dinars. So the question is giving us the fair value of NCI for what? To calculate the goodwill. So now if we calculate the net assets still over here, the sum is going to be 495 at acquisition and 575 at the balance sheet date. But the difference between this foreign subsidiary and a normal subsidiary is that we have all these values in dinars. So what we need to do is to convert these values into dollars. So we are going to apply an exchange rate onto this. Which exchange rate? So the rate, so if the net assets are at acquisition, the rate should also be at the date of acquisition. And to convert the net assets at balance sheet date, we are going to use the rate at the balance sheet date. So if we go back to the question, we have been provided these rates by the examiner. So May 2010 was the acquisition date and April 2011 is the balance sheet date. So the rate was 6 and 5. So we are going to apply the rate of 6 and 5 onto these. So now if we calculate the value in the local currency, it is going to be 495 divided by 6. So let's use a calculator for this. 495 divided by 6 is going to be 82.5. So net assets at the date of acquisition were 82.5. And similarly, 575 divided by 5 is going to be 115. So the net assets are increasing by how much? Thank you, Anwar Kareem. Thank you, Hassan, for providing the value. So they are increasing by the difference, which is 32.5. So now this 32.5 million is the value in terms of dollars. So we calculated all of the values in dinars and then we have converted them all together into the dollars. And in this, two people have share, parent and the NCI. What does parents share? Parents share is 52% and remaining 48% belongs to the NCI. So 32.5 into 52% is going to be 16.9 and 32.5 into 0.48 is going to be 15.6. Thank you, Hassan. So this is how we have calculated the values in terms of the dinars, and then we have converted that into the dollars. But now we need to understand one more thing, that This 16.9 actually has the impact of two things. One, this has the impact of net assets, and second, it has the impact of the movement in the exchange rates. So we can say that there are two impacts, the net assets one and the exchange rate one. So what is going to happen, that entire 32.5 relates to both of these. Now we call the exchange rate impact to be unrealized. Why? Because this is going to impact the company when we are actually selling the subsidiary. When we are selling the subsidiary, this will have an impact onto us, which is not our intention. So we say that this gain or loss, the exchange gain or loss, is basically a, yes, Simran, actually I was having a cough, so I disabled the mic for a while. That was why you were not hearing. So as we do not have any intention to sell the subsidiary, that is why we say that this gain or loss is the unrealized. So let me repeat for Simran that the gain or loss, this 32.5 gain, actually has two impacts. One impact of the increase in the net assets and the second in the exchange rates. So we have written two values, net assets and the exchange rates, and the total is 32.5. So now the impact of exchange rates, we call this to be unrealized. Why? Because the exchange rate is going to affect us when we are going to sell the subsidiary, which is not one of our intentions. So that is why we call this to be unrealized, and this should be taken to the OCI. And this should be taken to the OCI. Yes, Mengheng, you are right. BS means balance sheet, which is equals to statement of financial position. Simran is saying, sir, we share it to NCI because it's full goodwill. No, Simran, basically NCI always have a share of profit in both full and the partial goodwill. But in case of working two, it is going to impact whether it's full or partial. Zan is saying how exchange gain comprises two things, net asset and exchange rate. No, Zan. This value, this 32.51, is basically the increase in the net assets, which comprises the net assets and the exchange rate. So the movement in the net assets has two factors. This 32.5 is the movement in the net assets. This has two factors, the impact of net assets and the impact of exchange rate. Mira is saying because it was unrealized, then it should be recorded under OCI. Exactly, Mira, you have got the point. So now we need to quantify what is the impact of the net assets and what is the impact of the exchange rate. So if we see the value change in the net assets is how much? This is 80 million dinars. So we call this is the post acquisition profit of 80 million dinars, and we are going to convert this into the dollars. But as this is a profit relates to for the year, and if it's for the year, we should apply the exchange rate of which one? The average rate, which is going to be 5.8. So we are going to divide this by 5.8 to get the value of the profit in terms of dollars. So 80 divided by 5.8 is going to give us 13.8 approximately. So we are going to say that 13.8 is the impact of the net assets out of a total of 32.5. So this means the remaining impact 32.5 minus 32.5 minus 13.8 is 18.7, which actually relates to the impact of the exchange rates. So this is how we are going to divide the movement in the net assets between the profit and the exchange rates. Are you people getting this? Okay, so let's see your questions. Meera has got it. Simran is saying 1 minute, I need to see the working again. Yes, Simran, you can see that. Abid is saying, so if the dividend is given, should it be deducted? No, Abid, we are going to discuss dividends separately. In fact, in case of subsidiaries, you can simply ignore the dividends because the net impact of it is zero. Hassan is saying, what will be the double entry of effect of exchange rates? I will tell. Patrick is saying, no, I didn't get the split. Basically, Patrick, what is happening is, for example, if I go down, I'm going to say that the net assets at acquisition and net assets at balance sheet date. Let's suppose this was 100, this was 120. And then we applied the exchange rate of 5 and let's say 6. So what is going to happen is that this increase will have the impact of two things, the net assets and the exchange rate. The exchange rate impact is the unrealized, so it should go to the OCI, and the net asset should go to the P&L. So how do we calculate that? We actually calculate the increase in the net assets 20, and we divide that by the average rate to get this converted into the local currency. And once it is in the local currency, we go and write it down to the net assets. And then we calculate the balancing figure, the remaining value, as the exchange rate. So exchange rate is always the balancing figure. Okay, given Lungu is saying, is the exchange rate a gain or loss? Yes, it's a gain because the value is positive. That's why it is a gain. Frederick is saying, can we say net assets impact is mainly due to the change in retained earnings? Yes, we can say that, Frederick. Mira is saying for the parent company, the impact will have to be multiplied by 52. Yes, exactly, Mira. Mira is getting things right. Okay, so let me rub the explanation so that we can focus back onto the question that we were solving. So now what we have done so far is we have calculated the breakup of 13.8 and 18.7. So now what we are going to do, if I want to calculate the impact of the parent, I'm going to say that out of 16.9, some values should be going to the P&L and the other should be going to the OCI. So what is the amount to be taken to P&L? It is 13.8 into 52%. And what amounts to be taken to OCI? It is 18.7 into 52%, which is going to be 13.8 into 52%, which is 7.2 approximately. And the value taken to the OCI is actually 18.7 into 0.52. 2, which is 9.7. And if we calculate the sum of these two, this should be back to 16.9. If we calculate the sum of these two, this should be back to 16.9. So this is how we are going to break the values between what should be taken to the P&L and what should be taken to the OCI. Mohammed Rayyan is saying exchange difference it should take in individual financials or only in consolidated financials. Mohammed Rayyan, all of the workings that we are right now performing relates to the consolidated financials. So in the individual financials, there is no exchange gain or loss. This exchange gain or loss will be taken in the group financials. So Simran is saying, so there are two increase in the net assets. One is 32.5 and one is 13.8. Yes, basically 32.5 is in terms of this includes both the exchange rates and the profit. And this is only the profit. And this is the exchange rate. So adding both of them will become the total impact. Okay, Ogail is saying, so will you share the Word file? And it is very important to immediately share. Okay. Okay, Ogail, I will share all of the files of today and yesterday immediately after the session on the WhatsApp group so that you people can use that. Saqib Akhtar is saying, why not carry out working in subsidiary currency and then later translate them to make it easier? Saqib, this is what we have done. We have done all of the workings. We have done all of the workings in the subsidiaries currency, all of these, and then we have converted into the local currency. And once they are in the local currency, then we are going to carry further in the local currency. Patrick needs the WhatsApp group. Patrick, you can message me on my number. You can message me on my number. I will add you. A lot of people have already messaged. So if you want my contact number, it's +92 334 3739 697. You can message me on this. So let's get back to the question. So what we have done is we have calculated the working number 1 net asset so far. Now let's calculate working number 2, which is basically the goodwill. So in goodwill, we are going to calculate from the cost of acquisition, we're going to add the fair value of non-controlling interest and we're going to deduct the fair value of net assets. Now again, we are going to calculate the goodwill in the local currency as well. Exactly, Harsh, you are right. Patrick needs the number again. Patrick, this is my number. This one. Okay, Simran and Mohammed Rayan, I'll be sharing the previous session as well. Patrick, done, noted. Okay, good enough. So we are coming back onto the file where we were calculating the goodwill. So now when we calculate the goodwill, we need the cost. And we are going to calculate everything in the local currency, in the foreign currency, sorry. So if I see the question had given us the cost as $46 million. So what we're going to do, we're going to convert this into the foreign currency at the exchange rate, which was at the date of acquisition. And rate at the date of acquisition was how much? 6. So 46 into 6 is going to be 276. So the cost that we have paid is actually 276. And the fair value of NCI was given to us as 250 million dinars. So we are going to add 250 into this to get 526, the total. And then we are going to deduct the net assets, which we have just calculated. So the net assets are going to be 495. Why 495? Because we are calculating the goodwill in terms of dinars. So if we deduct 495, we are going to get the goodwill of how much? 31 million dinars. And now again, we are going to apply the exchange rate onto this to convert this into dollars. Now, which exchange rate should we apply? Which exchange rate should we apply? The rate at the date of acquisition or the rate at the balance sheet date? Harsh is saying both. Simran is saying acquisition, 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 acquisition. So everyone is saying acquisition. So yes, basically the rate is going to be applied at the date of acquisition, which is 6. And then we are going to get the value in terms of dollars. So 31 divided by 6 is equals to 5.2 approximately. I'm calculating everything in on one decimal place. But now there's one problem, that if we calculate the goodwill at 6, all other values in the balance sheet are going to be at the all other values in the balance sheet are going to be at the closing rate, but the goodwill would be at the opening rate or the acquisition rate. That would be inconsistent, because when we prepare the balance sheet, we are going to use all of the closing rates. So what should we be doing is we calculate the goodwill at 6, but then we are going to remeasure it and bring it back to 5. So 31 divided by 5 is going to be 6.2. So we are going to say that the goodwill was originally 5.2, but now due to the exchange rate fluctuation, it has increased to 6.2, resulting in a gain of $1 million, which is due to the exchange rate. This gain does not include any gain due to the net assets. This is only due to the exchange rate. Now, because we are following the full goodwill method, we are going to say that out of this, 52% relates to the parent and 48% relates to the NCI. So 0.52 of the exchange gain will be taken in the books of parent and 0.48 in the OCI. In the NCI. And this 0.52 will be taken to the OCI because this is due to the exchange rate movement. So as this was due to the exchange rate movement, we are going to take this to the other comprehensive income. Is it clear so far that how we have calculated the goodwill? And the next question that we are going to solve of the foreign subsidiary will be more complex, because that will actually include the goodwill impairment as well. So that will become more challenging, more tough, more technical. Okay, so yes, everyone has got the points. So now if we calculate, Harsh is saying, so what if we use partial goodwill method, will it have to split between parent and the NCI? Basically, this split is only applicable in case of full goodwill. If this method would have been a partial goodwill method, then entire 1 million would have been taken to the parent's OCI. If this would have been a partial goodwill method, we would have taken the entire to the parent's OCI. Yes, Ogail, in this we are taking 52% to the OCI. Yes, Meera, in full goodwill method, we have to split both in working 1 and working 2. Let me tell you something in detail, further detail, in fact, that I'm writing about partial goodwill, and I'm writing about full goodwill. So in partial goodwill, working one needs to be split. In full goodwill also, working one needs to be split between the parent and the NCI. In full goodwill, working two needs to be split also. But if it would have been a partial goodwill, then all of the working two gain or loss should have been taken to the parent only. Because the only difference between the partial and the full goodwill is the goodwill impact, not the net assets impact. So that is why only the change would affect working number two and not the working number one. Clear, Meera? Clear, Harsh? Harsh says okay, thank you. Welcome, Harsh. And Meera is also okay. So now we are going towards working number three. Clear to Simran as well. Now, when we prepare working number three, which is the non-controlling interest, we start from the fair value of NCI. And the fair value of NCI given to us was 250 million dinars. Now, because this was in dinar, so we are going to divide this by the exchange rate at the date of acquisition, which is 6. So I close the calculator. It was 250 divided by 6 is going to be 41.7. So the amount of fair value of NCI is going to be 41.7 initially at the date of acquisition. Thank you, Mohammad Rayan. Now we need to add the NCI's share of profit into this. And NCI's share of profit is going to be taken from both the workings, from working one as well as working number two. So the value in working number two was 0.48. We've brought it over here. And the value in the working number one was 15.6. So we are going to add both of them to get the value of the NCI. So it's 41.7 plus 15.6 plus 0.48. So the value is going to be 57.78. So this is how basically we are going to calculate the working 1, 2, and 3. Now, when we prepare working number 4, where we are going to have both the retained earnings and the other components of equity, which is also known as OCI. So anything which goes to OCI in the P&L will actually go to the OCE, other components of equity, in the statement of financial position. So anything which goes to OCI in the P&L will go to other components of equity in the balance sheet. So now if I go back to the question, the retained earnings in the OCE was 256 and 7. So I'm writing 256 and 7 for the parent, which is by the name of Rose. So let's call this Rose. And then obviously we will be adding the value of the petal, which we haven't calculated because we are focusing on the foreign subsidiary now. And then we are going to add the value of stem from both the working 1 and the working 2. So the value in working 2 was 0.52, and as this relates to the impact of the exchange rates only, we're going to add this in the OCE, other components of equity. And similarly, we need to check the value of the parent, which was 7.2 and 9.7 in the working number 1. So 7.2 taken to P&L and 9.7 taken to the OCI. So 7.2 and 9.7. So this is how we are going to write the values, and then after incorporating the adjustments, we can calculate the total. But in SBR, you will not be supposed to calculate all of the workings. Probably the examiner is going to tell you that we have calculated goodwill in some sort of ways, and then you are going to correct that incorrect goodwill calculated by the question. And if we talk about from what is important from paper's point of view, I'm going to tell you that in specimen 1, the examiner gave an area of disposal. In specimen 2, again, we had a disposal. In September 18, we have got a case of disposal plus cash flow statements in question number 4. And in December 18, we have got the cash flow again, the cash flow statement. So this means that for March attempt, for March 2019, apparently it feels that foreign subsidiary is going to be an important area. So this is something which you need to understand very carefully, because if it's not there in March, it is going to be there in June. But it's due time for the foreign subsidiary to come now. Simran is saying, can you explain working for again? Simran, basically in working for, we are adding the total reserves, the profits of everyone. So we have taken the reserves of the rows from the question, which was 256 and 7. And then we are going to add for the petal, which we are not solving right now. And then we have added the values for stem. 7.2 and 9.7 we have got from working 1, and 0.52 we have got from working 2. The exchange rate impacts have been taken to the OC, and the profits impact have been taken to the P&L. Ogail is saying, what are we calculating working for? Ogail, we are calculating the group retained earnings and the group's OCE. We are calculating the group's retained earnings and group's other components of equity, which will be taken to the balance sheet. Clear, Ogail? Okay, good enough. Harsh is saying, so what if there are other consolidation adjustments from the group retained earnings? Yes, Harsh, that is why I've written the adjustments over here, that after incorporating all of the adjustments, we are going to calculate the total. Simran is saying, thank you for being patient with us and explaining again. No problem, Simran. The core objective of the webinar is to facilitate you people and to get your confusions being cleared. So so when you people ask the question, that helps me out, that in which area do you people want me to go into the detail. So okay, we have done this question now. If we talk about some final impacts, that when you are going to prepare the statement of financial position, what we are going to do in all of the assets, we are going to add the value of rows plus petal plus the values of stem are going to be divided by the closing rate, which was 5, the balance sheet date rate, which was 5. Similarly, in all of the liabilities also, we are going to do the same. The values of rows plus petal plus stem divided by 5. So for example, if I look over here, I'm going to say 370 plus 110 plus 380 divided by 5. 15 plus 7 plus 50 divided by 5. So this is how we are going to calculate the non-current assets, the current assets. And the investment in subsidiaries are actually converted into the goodwill. These will be converted into the goodwill, which we have calculated in working number 2. Similarly, 118 plus 100 plus 330 divided by 5 will give us the total of the balance sheet side. And on the credit side, the share capital always belongs to the parent only. So it is going to be 158. Retained earnings and the OC, we have calculated them in the working number 4. So these values will come from working 4. And then we are going to write one more thing, which is the non-controlling interest, which we have calculated in working number 3. And then non-current liabilities 56 plus 42 plus 160 divided by 5. And then current liabilities 185 plus 77 plus 100 divided by 5. So all of the values which relate to the foreign subsidiary will be divided by the closing rate before being added into the balance sheet. Dullah Mambo is saying, hi, can we get the Word, Excel, and the edited PowerPoint files? Kindly share these workings in Word. Okay, basically these workings, the one which I'm writing down in notes, will be shared in the PDF format because there's no option to save in the Word. But I will be sharing this in the PDF, and inshallah, I will be sharing immediately after the session so that you people can benefit from that. Actually, in yesterday's session, I was very much tired after the session. I had a long day, all day classes, and then webinars. So that is why, after being tired, I slept, and in the morning, I had again the classes. So that is why that is still pending. But today, I will increase my energy level and ensure that I'm able to send it. So Harsh is saying, so we are using the closing rate for the assets and liabilities conversion, right? Yes, Harsh, that is the case exactly. So we are done with the question of rows, which mainly relates to the foreign subsidiary. Now, Petal, you can do it on your own, and the adjustments you can do it on your own because these are normal adjustments which relates to the accounting standards. So our objective was to mainly revise the foreign subsidiary. Okay, so let me open the next question, which is going to be bubble. So now bubble is comparatively a bit of more difficult because in this we are going to have some goodwill impairment as well. So let's see, the question says that the following draft financial statements relate to Bubble, a public limited company, and the two other companies in which it owns investment. Okay, so now we have Bubble, which is in $1 million. We have Salt in $1 million. We have T, let's call this T in $1 million, in million dinars, sorry. So now again, the investment in both of the subsidiaries have been given, which we are actually going to convert into the goodwill. And we're going to use investment of 46 to calculate the value for the foreign subsidiary. Now again, when we are preparing the working number 1, we are going to use these three values, the retained earnings, the other components of equity, and the equity shares to prepare the working 1. And if you note, we never have the other components of equity in case of a foreign subsidiary because that will become way too difficult for the students to solve if we have the OCE in the foreign subsidiary as well. So let's solve this question. So now I'm going to start the question by the name of bubble, which attempt? It is December 2015. Question number 1. Okay, so again we are going to start from where? From the working number 1. So working 1 is basically the net assets. And in the net assets, we are going to prepare 2-column net assets at acquisition and net assets at the balance sheet date. And we're going to write the equity shares, which is also known as the share capital. We're going to write the retained earnings, and we're going to write the other components of equity. So the value given in the question was 210 and 292 at the balance sheet date. So 210, 292 and 0 for the other components of equity. Simran is saying, sir, how to know which P2 questions are still relevant for SBR? Simran, basically, in with respect to section B, all P2 questions are relevant. All P2 questions are relevant. But when we talk about section A, I'm going to say that all ethics questions are still relevant. Only the consolidation questions are to be adjusted, which are going to be divided into parts and focusing more on theory rather than the calculation. Simran, this is T, Teisler. We are solving about Teisler, 210, 292. So now let's read the question to see what values were at the date of acquisition. The share capital will be the same, but the retained earnings would be different. So the question says that this is the part which is relevant to us. That Bubble owns 60% of the equity shares of T, a company located overseas, which uses the dinars as its functional currency. So we have acquired 60% of the shares. The shares in T were acquired on 1st November 2014 at a cost of 368 million dinars. So 60% is relevant to us. 368 million dinars is relevant to us. And at the date of acquisition, the retained earnings were 258 million dinars. This is what we were looking for. So retained earnings were 258 at the date of acquisition. So 258 is relevant for us. And T had no other components of equity. So the other components of equity is zero at both the acquisition and the balance sheet date. No fair value adjustments were deemed necessary in relation to the acquisition of T. So there are no fair value adjustments. The fair value of the non-controlling interest was estimated at 220 million dinars at the date of acquisition. So in this paragraph, there are four important values to us. The acquisition rate of 60%, the cost of 368 million dinars, the retained earnings of 258, and the NCI. So we can write this is the NCI, this is the retained earnings, this is the cost, and this is obviously the percentage. So now let's calculate the total. So the total is going to be 468 and it is going to be 502. Am I right? So now we are going to apply the exchange rates onto this. And the exchange rate is going to be the exchange rates are going to be somewhere here, these ones. So we need the acquisition date rate, which was in the balance sheet date, which is 9.5, and the acquisition was on 1st November 2014. So the acquisition rate is 8 and the closing rate is 9.5. So we are going to divide this by 8 and divide this by 9.5. Okay, so now let's calculate the values. And the values are going to be 468 divided by 8, which are 58.8, 58.5, and 502 divided by 9.5 is going to be 52.8. So this means that we are at a loss this time. Loss of how much? 52.8 minus 58.5. So we are at a loss of $5.7 million. And out of this 5.7, this relates to two parties, 60% to the parent and 40% to the NCI. So 5.7 into 60% is negative 3.42, and 5.7 into 40% is going to be 2.28. So we can call this 3.4 and 2.3. So this is how we are going to break down the values. Thank you, Mutazasan. Thank you, Simran, for the values. Okay, now what is going to be the next step, the most difficult one? The next step is to break this amongst the P&L and the OCI. This time, can you try on your own? Give it a try that how do we calculate the exchange gain or loss, the P&L and the OCI breakup. Okay, so how do we calculate this? We're going to use the increase in the net assets, which is going to be 502 minus 468. 502 minus 468 is going to be 34. So we are going to divide 34 by the average rate, which was given in the question as 8.5. So divided by 8.5 will give us the value relating to the net assets. So 34 divided by 8.5 is equals to 4. So 4 is the value which mainly relates to the P&L. But this is a total value. For parent, it has a 60% share, which is going to be 2.4. So we are going to say that 2.4 actually relates to the P&L. Okay, Musharraf is saying if we show working like you in the exam, is that will be fine. Yes, Musharraf, the examiner will be asking you the theoretical discussion on these values. And the workings that we are performing is not exactly the answer. It is the workings to the answer. So the workings can be performed in any way. So you can exactly do as I am doing, because when I teach in the classroom, I teach my students the same way, that you have to simply do the same thing, same steps, so that the memory in your mind can be easily converted onto the paper. And then we are going to discuss right theory onto that. Okay, now BB Farida is saying 2.4 and 1, and Mira is saying 5. Simran is saying I'm still confused for the split of PNL and the OCI. Simran, no worries. You can revise this after today's session, and if you still have problem, you can send me a voice note on WhatsApp. I will reply to you on that. Okay, now one thing which is very important, the mistake that I'm seeing people are doing in providing me the values is that people are saying that breakup is going to be 2.4 and 1, which is not the case. Why? Because, yes, Murtaza has got the correct answer this time. Because this is a loss of 3.4. and this is a gain of 2.4. So this means that the loss that should be written is going to be 5.8 in the OCI. The loss to be written in the OCI is going to be 5.8. Yes, Cindy, I will be informing that how we are going to write these values into the wordings. So because 2.4 is the gain and 3.4 is the loss, so the balancing figure of 5.8 will be taken to the OCI. Ryan is saying how 5.8. Ryan, check this out. The profit is 2.4 and we are going to calculate the exchange impact and the total is negative 3.4. So what should be the exchange gain or loss to get negative 3.4? Mohammad Rayan, if the profit is positive 2.4 and we have to get a total of negative 3.4, then what is the exchange gain or loss? Yes, Murtaza, you are right. But I want to listen from Rayan, Mohammad Rayan. Rayan, have you got it? We need to deduct 5.8 from here to get a negative 3.4. So this is how we have actually calculated the balancing figure. Getting it? Okay, Ogail is saying very clear explanation, sir. I'm enjoying the lesson. Thank you, Ogail. Even I'm enjoying the to teach you people. Okay, so now we are done with the working number one, which was exactly the same as the previous one. And now we are continuing with the working number two, which is the goodwill. And this time we are going to have some new areas to discuss. Now again in the goodwill we are going to write the cost. We are going to add the fair value of the NCI and then we are going to deduct the fair value of the net assets to get the goodwill. Now the cost was again how much? If I go to the balance sheet, I can find the cost to be 46 for Teisler. So 46 multiplied by the exchange rate at the date of acquisition, which was actually 8. So 46 into 8 will give us the cost. 46 into 8 is going to be 368 million dinars. So the cost we have paid is for 368 million dinars. And if I want to check the fair value of NCI, it was actually 220 million dinars. So we are going to add it up and the total is going to be 588. And the net assets that we have calculated in working one was in dinars, they were 468. So minus 468 will give us the goodwill of 120. So 120 is the amount of the goodwill. Thank you, Mutazan Hassan. So now we are going to apply the exchange rates onto this. And the exchange rate is going to be both the acquisition rate and the balance sheet rate. Am I writing the right rates? Yes, 89.5. So 120 divided by 8 is going to be 15. So 15 was the goodwill at the acquisition. But there's one more problem. We haven't read the question completely because there's going to be some goodwill impairment as well. There's saying no need to thank again, sir. Even thank you for that, Murtaza. Okay, now the question has one more paragraph, where the question says that an impairment review of goodwill was undertaken at 31st October 2015. So we are impairment testing the goodwill, and no impairment was necessary in relation to salt. But the goodwill of Teisler is to be impaired by 20%. So the goodwill is going to be 20%. Neither Bubble, Salt, nor Teisler has issued any equity shares since the acquisition. Okay, Fahim is saying, I really appreciate your energy level. Thank you, Fahim. So 20% of the goodwill is being impaired. If I go back and let me answer Ogail as well. Ogail is asking, where did you get 468 from? Ogail, this 468 is the net assets at acquisition, where we have got from the working number one, this one, 468, the net assets at the date of acquisition. Simran is asking that why do we use two exchange rates on the goodwill, 8 and 9.5? Okay, Ogail, have you seen 468? From where have we got it? Okay, good enough. So now let's answer Simran. Simran is asking why we are using two rates. Simran, the reason is because the goodwill is actually calculated at acquisition. So that is why we used 8 to calculate the goodwill of 15. But when we are going to prepare the statement of financial position, all of the assets and all of the liabilities are going to be consolidated at which rate? At 9.5, the closing rate. But if we write the goodwill at the rate of 8, that would be inconsistent. That when everything is at 9.5, why the goodwill is at 8? So that is why we need to remeasure, retranslate the goodwill to the closing rate as well, to ensure that all assets and all liabilities are measured at the closing rate. Okay, Simran has got that. Okay, Bablu Hussain is saying why we are taking balancing figure for OCI amount. Basically, Bablu, the reason is that we need to identify the impact of the exchange rates. So what we did, we calculated the profit and we got the balancing figure as the OCI. So this has actually saved our energy and time onto that. Okay, now let's discuss the area of impairment where the question is saying that 20% of the goodwill has been impaired. Okay, the one that is saying 3 million in the impairment. Now, actually, this is something very important that you people need to understand, that if I deduct 20% of 15 from over here, I may be wrong in that case. Why? Because we are calculating the goodwill in actually dinars. So what we should be doing, we should be recognizing the impairment of 120 into 20%, which is going to be 24 million. And we're going to deduct 24 million from here, which is the impairment. And the goodwill at the balance sheet date is going to be 96. So we can say that the goodwill at acquisition was 120, but at the balance sheet date, the goodwill has impaired and brought down to 96. Murtaza is saying, does IS 21 says to remeasure the goodwill at the reporting date? Yes, Murtaza. IS 21 has two different parts, one relating to foreign transaction and one relating to foreign subsidiary. In foreign subsidiary, IS 21 says that all assets and all liabilities, including the goodwill, should be remeasured at the reporting date. So now the goodwill at acquisition date was actually 120, and at the balance sheet date, it has been impaired by 20% to give us a value of 96. So when we retranslate the goodwill at the balance sheet date, we are actually going to use the rate of 96 divided by 9.5. So the goodwill at balance sheet date is actually 10.1. So this is how we have calculated the goodwill. At the date of acquisition, we use the goodwill at acquisition and the rate at acquisition. And at the balance sheet, we have used the rate at the balance sheet as well as the goodwill at the balance sheet. Yes, Fahim, you are right. I'm coming to this point. So now we have got the goodwill from 15 to 10.1. This means that the goodwill is being reduced by 4.9. So we are writing negative 4.9 onto this. Okay, Yajna is saying that can we divide 120 by 9.5 and then take the impairment? No, Yajna, we cannot do that. Actually, I will solve it both the ways for you people. So let's consume this space. So actually, why we are not doing so? Like for example, I'm writing 120 divided by 8, which was 15. So if we divide 120 by 9.5, if we divide 120 by 9.5, we are going to get a value of 12.6. And now if we take 20% of that, it will be 2.52. So the value that we are going to get is going to be 12.6 minus 2.5, which is the same 10.1. But what will happen is the thing that we are going to do the next, that you are going to get same 4.9 that we have got. But what will happen is going to be the next, that we are going to divide this 4.9 between the parent and the NCI by how much? By 60% and 40%. So 4.9 into 0.6 is going to be 2.9. And 4.9 into 0.4 is going to be the remaining 2. So this can obviously be done over here as well, 2.9 and 2. So right now, up till now, both the methods are the same, but they are going to differ in a while. Okay, Harsh is saying, sir, we split because we used full goodwill method again. Yes, exactly, Harsh. If we would have used the partial goodwill method, we would have taken entire 4.9 to the parent's financials, to the parent's share. Now what will happen? This is something very important and the actual area that we had to discuss is that this 2.9, should this be taken to P&L or the OCI? The loss of 2.9, should this be taken to the P&L or the OCI? Harsh is saying OCI, Mohammad Saad is saying P&L, Fahim is saying OCI, Hassan is saying OCI, Mohammad Rayan is saying P&L. Now if we see this time, Ogail is saying we need a question with partial goodwill to grasp that concept. Okay, Ogail, I will do one question of partial as well. Basically, one thing that we have to note that this time the movement, what is the reason of the movement? This time, what is the reason of the movement of 4.9? Is the reason impairment or the reason exchange gain or loss? Yes, Harsh has got the right answer up till now. Meera is also right. Basically, this is because of both. This is because of both. This is because of the exchange rate movement as well as because of the impairment. So the impairment effect should be taken to the P&L and the exchange rate effect should be taken to the OCI. This time negative 4.9 has two reasons. One is the impairment and the other is the exchange rate. So that is why we need to break this into both. Some impact taken to the P&L and some impact taken to the OCI. Now, how much sum? So we are going to say that the impairment loss was of 24 million dinars divided by the average rate of 8.5. 24 divided by 8.5 is the value which is to be taken to the P&L. So I'm writing here 24 divided by 8.5, and this will give us the loss relating to the entire company. So we will be taking 60% of this to calculate the loss that belongs to the parent. So 24 is the entire loss divided by 8.5 to convert into dollars, and into 60% to calculate the parent's share, which is going to be 1.7. So 1.7 of the loss is going to be taken to the P&L. I was saying very good. This cleared my concept. Thank you, Fahim. So 1.7 is now taken to the P&L because this actually relates to the impairment. And the remaining balancing figure will be taken to the OCI. Now, what is going to be the balancing figure? Now, what is going to be the balancing figure? Hassan is saying 4.6 and all of the remaining are saying 1.2. Yes, 1.2 is the right answer because this time both are loss. So 1.7 of the loss plus 1.2 of the loss will make it 2.9 of the loss. So this time 1.7 and 1.2 is going to be taken to the P&L and the OCI. Now let's prepare working number 3, which is going to be the NCI. And we're going to start from the fair value of NCI, which was, let's refer to the question, which was 220 million dinars. So the fair value of NCI is going to be 220 divided by the rate at the date of acquisition. So 220 divided by 8 is going to be 27.5. And then we are going to add the share of profit into this from both the working 1 and the working 2. So the share of NCI in working 2 is -2, and the share of NCI in working 1 was -2.3. So it's -2.3 from working 1. So this is going to become 23.2. Let me check. 27.5 minus 2.3 minus 2.3 and minus 2 is going to give us 23.2. Yes. Okay, Tracy's saying that she can't hear me. Can everyone else hear me? Yes, yes, yes. Clear. Okay, good, 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 good. A lot of yes. Okay, Simran is saying, sir, is it necessary to take 20% of dinars, not the dollars? Because question didn't mention. Basically, yes, Simran, it is necessary. Why? Because if you see, if you would have followed this method, this one, you cannot calculate the value to be taken to the P&L and the OCI because we have calculated the impairment in dollars already. Although this is not the value which is to be taken. So that is why it is necessary to calculate it in the foreign currency and then convert it into the local currency. Getting the point, Simran? So impairment always in foreign currency, yes. In case of a foreign subsidiary, no. in all cases, not only in this case, in all cases of foreign subsidiary, we are going to calculate the impairment in the foreign currency. Okay, so the last working, which is working number 4, is going to be the group retained earnings and the group's other components of equity. The group's retained earnings and the group's other components of equity. So if I go back to the question, the retained earnings and the OC or the parent was 230 and 40. So I'm writing 230 and 40 for the parent, which is the bubble. And then we have two subsidiaries by the name of Salt and Teisler. So we should be adding the values of the Salt, and then we are going to add the value of Teisler. And this we are going to get from both the working 1 and the working 2. So the values from working 2 were 1.7 and 1.2, both are negative. Okay, Musharraf is saying that, sir, please would you also show us how to write the written part as you mentioned? Yes, I will be going towards the written part after completing the calculation part. Okay, so if I go further upwards and check the values in working 1, so these were 2.4 and 5.8, positive 2.4 and negative 5.8. So this is how we are going to calculate the working 4. And if there are any other adjustments, we are going to adjust those. And then we are going to calculate the total of the working 4 retained earnings and the OCE. So this is how we have solved two different questions of the foreign subsidiary. Abdullah Mambo is saying salt. Abdullah, we haven't calculated the values of the salt because we were focusing on the foreign subsidiary one. Simran is saying kindly give examples of adjustments required. Simran, basically the adjustments are the ones that relate to these ones, these values. So any debit or the credit would be affecting the P&L. So that will be adjusted through the adjustments. Murtaza is saying, sir, why have you chosen preparation question if there would be little need of the calculator in the exam as was in December attempt? Murtaza, basically, if you know the calculation, you can write that in the theoretical format. The theory that we will be writing is not some general theory that will be based on the application to the scenario. So if you have understood the calculations, only then you will be able to write it theoretically. So the purpose of solving this question was to understand what is being happening. And once you know what is happening, that will be easier for you to write in the exam. Simran is saying, so this will come in the working. Yes, yes, Simran, this will come in the working, but in the SBR exam, you should not expect a complete working 4 to be prepared. In SBR exam, you will be divided into different parts. So like for example, the question says to calculate the NCI of foreign subsidiary only, or to calculate the goodwill of the foreign subsidiary only. Or it says that we have calculated the retained earnings, but we haven't calculated the share of profit of the foreign subsidiary. So please correct that. So the question will be focusing on some specific areas, not the entire ones. Okay, so now we are going to write the theory part of the foreign subsidiary. So let me open a Word file for that. So we are using day 2. So what if the question asks you to discuss the accounting treatment in case of a foreign subsidiary? What accounting are we going to write? Okay, Ogail is saying, sir, will be some 2 minutes break at least. Yes, Ogail, let's write down this and then let's take a break and then come back with the cash flow statements. Let's write this down and then take a break so that at least the foreign subsidiary area is completed. Okay, so I'm writing the answer, theoretical part. Anwar Karim is asking, sir, are we doing ethics as well today? Anwar, I don't think so that we will be getting time to do ethics, but no problem, we'll do it tomorrow. So in tomorrow's session, I will add the ethics into the analysis part so that we can solve half of the day with the ethics and half of the day with the analysis. Because consolidation is a very important area, it will be there in every case. And approximately 15 to 20 marks would relate to the consolidation. Simran, the session will end on Friday. It will be ending on Friday. No, I think it will be ending on Thursday. It's Monday, Tuesday, Wednesday, Thursday. It's a 4-day session. So Monday we have discussed, Tuesday gone, and Wednesday, Thursday will be the remaining days, which is tomorrow and day after tomorrow. Okay, so now let's write down the answer. So we are going to say that in case of a foreign subsidiary, and let me tell you the format of the answer as well. In SBR, you are going to write some general points, the rules that applies onto the case. And then you are going to write the application on the case. And then you have to write the conclusion. So these are 3 steps of writing the SBR answer. First, define the rules, not the general one, the rules that are relevant to the case. And then write the application, that in the case, how these should be applied. And then write down the conclusion, that what now the company should be doing. So these are 3 steps of basically writing down the SBR answer. So what we can do right now is we can only write the general theory. So I'm going to say that in case of a foreign subsidiary, the net assets of the subsidiary at the date of acquisition are calculated in the foreign currency and then translated into the local currency using the exchange rate at the date of acquisition. The same net assets are used to calculate the goodwill. So this is the first statement that we have written about the net assets that relates to at the date of acquisition. Any change in the net assets at the balance sheet date is the post acquisition profits. I'm writing in local currency. So any change in the net assets in the local currency at the balance sheet date is the post acquisition profits, which is partly recorded in the profit and loss and partly in the other comprehensive income. The movement that relates to the exchange rates are treated as an unrealized gain or loss. and are taken to the OCI with the movement in the net assets only are taken to the profit and loss account. So this is where we have defined the net assets at acquisition and its impact on the goodwill calculation. And then we have discussed the changes in the net assets, how they are accounted for. And now we are talking about the impairment. In case of any impairment in the goodwill, the impairment loss is initially calculated in the foreign currency and converted into the local currency using the average exchange rate. And any impact on the goodwill due to the movement in the exchange rate is taken to the OCI. So first we have discussed about the goodwill, the net assets at acquisition, and the goodwill calculation. These net assets at acquisition and the goodwill. And then we have discussed about the post-acquisition profits, and finally we have talking about the goodwill impairment. So this is how you are going to write the theory in the exam. But if there's no goodwill impairment, you do not need to write this value, this part. Getting the points, all of you? Murtaza is saying that the rule should be our own understanding or the one stated in the standard, like concepts and the principles. Basically, Murtaza, your understanding should be the concepts and the principles defined in the standards. So you are going to write the standards actually in your own wordings. You're going to write the rules in your own wordings. Mira is saying that the rules should be general. Yes, Mira, the rules should be general but case specific. Like for example, if the question is talking about impairment, then we will write this, otherwise not. So anything which is not in the question should not be written, and anything which is in the question should be written as a general rule. Zelna is saying the slide is stuck. Okay. Harsh is saying, sir, we can say that the movement in goodwill due to impairment only is taken to P&L. Yes, Harsh, we can say that. Mira is saying, do we need to write the IS number and the name? Mira, it's better to write the number at least, but writing the full name will actually take more time. But if you do not remember the number, that's no issue. You cannot write that. It's better not to write rather than writing a wrong number. It's better not to write if you don't remember it. So this is how we have completed the part of the foreign subsidiary. Now let's take a break. It's 9:29 at my side, and we are going to take a break and then continue in 15 minutes. Or let's take a 10 minutes break so that we have more time to discuss the cash flow statements. So we get 10-minute break and then we are continuing at 9:40. Simran is saying that it's 12 midnight in my country. Okay, let's reduce the break to 5 minutes. Let's make it a 5 minutes break. So we are continuing at 9:35 so that more time can be invested. So 5 minutes break. Okay, everyone, welcome back, and let's continue the session now. And up till now, what we had discussed was actually the foreign subsidiary. Now we'll be moving towards the cash flow statements. And the questions that we're going to solve in cash flow are going to be question number 4, part B, David, of September 2018, and then December 2018, question number 1 by the name of Moise. So let me open the question. Let's start with the David first. Do you people have this question, David and Moise? Do you people have this question? Okay, good enough. So let's start the question. The question says, let me open this in the other format. Okay, so the question actually says that David is a car retailer who leases vehicles to customers under the operating leases and often sells the cars to third parties when the lease ends. So we provide the assets to lease on some third parties, and then when it ends, we actually sell them. The net cash generated from operating activities for the year ended 31st August 2008 for the David Group is as follows. So what David has done, he has written cash generated from operating activities as 345, and the income taxes paid at 21, and the pension deficit payments are 33, and the interest paid is 25, and the associate share of profit is 12. So David has calculated the net cash generated from operating activities as 278. Now let's see what is the requirement of the question. The question's requirement is that prepare an adjusted statement of net cash generated from operating activities to correct any error above. So the question wants us to prepare. The word prepare means to calculate in this case. So this is purely a calculation based requirement where we need to adjust the statement of cash generated from operating activities. So what we are going to do, we are going to write the question that we are solving. It's David, which is question number 4 of September 2018 attempt. So what we'll be doing, we will be preparing the answer as the adjusted cash generated from operating activities and we are going to start from the cash generated as per the question. So the question has actually given us the cash of 278. So we are going to start from here and we are going to adjust the incorrect values and to calculate the correct answer. Murtaza is saying the associated profit is seen and it's incorrectly included right at the front. Yes, basically there are a few some errors which can be seen up front, but let's discuss one by one. Harsh is saying, Sir David is from which year again? It's December, it's September 2018, question number 4. Okay, Harsh? It's September 2018, question 4. Now, apart from this, the question also requires a reconciliation. The question also requires a reconciliation from the net cash generated by operating activities to operating free cash flows. Now, these operating free cash flows is something which relates to APMs, additional performance measures, which is a part of the area of analysis. And then the question says that an explanation to the adjustments made in part 1 and 2 above. So we also need to explain, this is the theoretical part that we need to explain. And the areas that we are explaining are the adjustments. So 5 marks for the theory and 8 marks for the calculation. Okay, so now let's go back and let's see what the question has to say. These two first parts actually relates to the APM. But let's read it still. The question says that the net cash flow generated from investing activities, this is something relating to investing activities. So this is not a part that we have to discuss. But still, let's read this. Included interest received of $10 million and the net capital expenditure of $46 million excluding the business acquisition at 3 below. So this is basically to calculate the free cash flows in the APM's part B. Now the question further says that there were some errors in the presentation of the statement of cash flows which could have an impact on the calculated net cash generated from operating activities. So this is something which is relevant to us. Simran is saying, sir, is it adjustment from one? No one. I didn't get your question, Simran. Now the question says that the directors have provided the following information as regards any potential error. Now from here we have to be active and focused to identify the errors. Okay, so part 1 says that cars are treated as property, plant and equipment when held under the operating leases. So the cars are treated as property, plant, equipment when we are holding it under the operating lease. Is this right or wrong? Is this right or wrong? Harsh is saying wrong. Mohammad Saad is saying wrong. What is I saying? Can you share the standard APMs commonly used in calculation? Murtaza, we will be discussing the APMs in tomorrow's session. Okay, so everyone is saying wrong, but this is right. But this is right because when a company provides some assets under the operating lease, so the company should treat those assets as a part of property, plant, equipment. The assets that we have are property, plant, equipment. So the treatment is right. So Patrick is only is the only one who is right. So basically, what happens is, for example, if I have bought a car, if I have purchased a car, I should make the entry as property, plant, equipment debit, and the bank credit. And then I've given this car to lease to rentals. So this should remain in IES 16. But if the intention would have been a finance lease, if the intention would have been a finance lease, then we would have said that this treatment is wrong. But normally in case of operating lease, the assets are treated as a part of property, plant, equipment. Because when we study the scope of IES 16, IES 16 says that when the intention of an asset is to use or to earn rentals, it should be classified under IES 16 other than the property. Because if the property is given on rentals, it would become IES 40. But any asset other than property, if we are renting it out, it is IES 16. Simran is saying, sir, if finance lease under what? Under IFRS 16, Simran. Finance lease under IFRS 16. Ogali is saying, does IES 16 still apply or we use IFRS 17? Basically, Ogai, IES 17 has been replaced to IFRS 16, but IES 16 is still there. Bright is saying it depends on the business model. No, Bright, in if we are leasing any asset other than property, it's IAS 16, irrespective of the business model. Harsh is saying IAS 17 still applies to the lesser accounting. Harsh, basically IFRS 16 has copied the lesser accounting from IAS 17. So IAS 17 is not more is no more applicable. Everything is as per IFRS 16 now. Fahim is saying, can we lease intangible assets? Yes, Fahim, you can provide some softwares on a rental basis, which is quite common these days. Like for example, if your company is using SAP accounting system, the ERP system. So SAP is what they are basically doing. They are providing it on a license to different users. So then IAS 38 is going to apply, obviously. Okay, so now let's read further that the question says that cars treated as property, plant, and equipment when held under operating lease. So up till here, the treatment is right. But then the question says when they become available for sale, they are transferred to inventory at their carrying amounts. This is also right. That when they are being available for sale, this becomes an inventory. Why inventory? Because our business is to provide cars on operating lease and then sell them to third parties when the lease ends. So until the asset is given on operating lease, it is property, plant, equipment. When it's back and available for sale, it is going to become an inventory. So the treatment up till now is right. Simran saying available for sale should be IFRS 5. Simran, it would have been IFRS 5 if our business was not to sell the cars. Then it would become IFRS 5. If it's a business, then it is going to be IAS 2. And the question has mentioned at the start that that it is a business. In SBR, the information is going to be disbursed. Some relevant information given at the start, some relevant information giving at the end, some relevant information giving at the mid. So you need to actually grasp all of the important informations, and then you are going to draft the answer. Okay, Mohammad Saad is saying, doesn't the inventory is carried at lower of cost NRV? Yes, Mohammad Saad, the inventory is carried at lower of cost NRV. So the carrying amount of the asset is basically the cost in terms of the inventory. Because we haven't acquired the property, the cars, so the carrying amount of PPE would become the cost in IES 2 inventory because we haven't purchased that car. So let me give you people an overview over here that any asset given on operating lease is normally going to be your IES 16. And when it is available for sale, we are going to see that is this a business of ours? If it's a business, then it will become an inventory under IES 2. And if it's not a business, it will become IFRS 5. If it's inventory, it should be valued at the lower of what? Cost and the NRV. And in this case, the cost is going to be the carrying amount as per IES 16. And we know the NRV. And if it's IFRS 5, we are going to carry it at the lower of the carrying amount, which is the same carrying amount as per IES 16, and the fair value less cost to sell. So this is how we actually measure the uh, case. So assets given under operating lease is IAS 16, and then we are going to sell. So we have to see whether it's a business or not. Okay, Carl is saying hi there. Hi, Carl. Can you please advise where can I find recording of yesterday's webinar? Um, Carl, the recordings are available at www.vimeo.com. Admin will also reply to you on this /ACCA Pakistan. So you can use this link to find the videos of the previous webinars. Okay, so admin has also shared the link, so you can follow that too. Okay, so Simran is saying why is the carrying amount as per IAS 16? Because Simran, it is such that we have actually acquired the inventory at today's time. So the carrying amount of IAS 16 is basically a sort of a cost when we are bringing to the inventory IAS 2. So if I go back, the accounting over here is up till now correct, completely correct. The accounting till here is completely correct. Now the question says in its statement of cash flows for the year ended 31st August 2008, the cash flows from investing activities includes the cash inflows relating to the disposal of cars of $30 million. So now is it correct or wrong? We have shown the disposal of cars in the cash flow from investing activities. Is this right or wrong? Yes, this time it is wrong. Why it is wrong? Because this is an inventory to us. If it's an inventory, it's an operating activity. If it's an inventory, it's an operating activity. So inventories are an operating activity. So as this is an operating activity, this should be a part of the operating activities cash flows. And if it would have been an IFRS 5, then it would have been treated as the investing activities. So inventories are a part of operating activities. So what we are going to do, we are going to correct this impact, and we should now be starting the correction. We should add cash from the disposal of inventory, which are the cars. So we should be adding $30 million into the cash flow from operating activities. We should be adding the cash from the disposal of inventory in the operating activities because the question has mistakenly included these in the investing activities. So clear till now? Harsh is saying, thank you, sir. The concepts until now are very clear. That's great, Harsh. So yes, everyone is clear so far. Let's move further towards the question. So now first adjustment has been done. The second adjustment says that on 1st September 2007, David purchased a 25% interest in an associate for cash. So purchasing associate is a cash flow from investing activity. The associate reported a profit after tax of $16 million and paid a dividend of $4 million. Out of these profits in the year ended 31st August 2008, the directors had incorrectly included a figure of $12 million in the cash generated from operating activities as the cash generated from investment in associate. So this is an error that the question has included $12 million of the cash, although the dividend paid by the associate was $4 million and we would have a share of 25%, which was 1 million, And even this 1 million should be taken to the cash flow from investing activities. What impact of associate is taken to the operating activities? Let me write this down. Then when we talk about associate, about IES 28, there are three values which are in total relevant to us. One is the purchase of associate. If we are purchasing an associate, that should be taken to the cash flow from investing activities. Second, the profit of associate, or I can say the share of profit in associate. This is something which is added in the profit. So as it is added in the profit and it is not non-cash, but is non-cash. So what do? Is we are going to add it back in the cash flow from operating activities because it is non-cash. And the third thing is the dividend received from associate. So any dividend received is treated as a cash flow from investing activities. And if there would have been any impairment of associate, if there have been any impairment of associate, that is going to be added in the cash flow from operating activities again because this is non-cash. So these four values are basically relevant to the cash flow statements in case of associate. So now what should have been done is that the associate's profit was reported as 16 and we had a 25% share of that. So we would have added 4 in the CFO, but the question has mistakenly added 12 in that. So what we are going to do? We are going to deduct 16, 12 for which was incorrectly added and 4 which should be deducted. Reversal of incorrect profit. You can even write it separately. First we are reversing the 12 and then we are reversing the share of profit in associate, which is basically a non-cash item. So that is why we are deducting it. Simran is saying, so the profit is added in the P&L, so why add again in CFO? Simran, we do not add it, we actually deduct it. The share of profit is going to be deducted. This is going to be added. This is going to be deducted. We are saying that this is already added in the profit, so that is why we are going to deduct it. Dividend received will be added and the impairment loss will also be added. Mohammad Ryan is saying that we should pass entries. Mohammad Ryan, there's no requirement of entries. You should be preparing the entries when the question says so. So obviously you can prepare for your own use, but they are going to consume more time of yours in the exam. So that depends on the way that you have learned. If you have learned from the entries, obviously you will have to do that then. Okay, so let's get back to the question. So now we are done with the adjustment number 2 so far. Let's read further. The question says that the associate was correctly recorded at 23 million in the statement of financial position, and the profit for the year of 4 million was included in the statement of P&L. So this is the 4 million which we have deducted. So 12 million which was incorrectly included in 4 million, we have already adjusted this. So we are done with the adjustment number 2 now. Let's move to the adjustment number 3, where the question says that David also acquired a digital mapping business during the year ended 31st August 20x8. The statement of cash flows showed a loss of 28 million in the net cash inflow generated from the activities as the effect of changes in foreign exchange rates arising on the retranslation of this overseas subsidiary. So here is another problem. What is the problem? That in case of a foreign subsidiary, IAS 21 talks about two elements. Let me write it on the next page. IAS 21 actually talks about two types of transactions. One is the foreign transaction and other is the foreign subsidiary. So exchange gains and losses on foreign subsidiary are basically taken to the OCI that we have just discussed in the previous topic of the foreign subsidiary. And the gain or loss on foreign transactions even have two types. Either they are going to be monetary or they are going to be non-monetary. The gains and losses on the monetary items are taken to the P&L, and the gains and losses on the non-monetary can be taken in the P&L and can be taken in the OCI depending on the cases. Depending on the cases. Hassan is saying that unable to see the screen. Is everyone else able to see the screen? Harsh is saying yes, 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 yes. Okay, Hassan, if you are having a problem, you should rejoin the session. Sikandar is saying exchange loss to OCI. No, no, Sikandar, both exchange gains and losses. We are talking about both the exchange gains and losses will be taken to OCI and will be taken to PNL. And this depends on the case, means that if this is along with impairment loss, it will be taken to PNL. If it is along with the disposal, it will be taken to PNL. But if it is due to the revaluation gain, it will be taken to OCI. If it's due to revaluation loss, it will be taken to PNL. So this is something which is a detailed concept of IAS 21. So I'm just giving an overview right now. No, Mohammed Saad, retranslation reserve is something which relates to the foreign subsidiary only. Retranslation reserve is something which relates to the foreign subsidiary only. So now what has the question done? Let's read it again. That David also acquired a digital mapping business during the year. The statement of cash flows showed a loss of 28 million in the cash inflow generated from operating activities as the effect of changes in foreign exchange rates. So this 28 million would have been taken to OCI, and this has no relation with the cash flow from operating activities. So what we need to do is we need to eliminate this impact of 28. The question further says that the assets and liabilities of the acquired subsidiary had been correctly included in the calculation of cash movement during the year. So what we are going to do is that we are going to deduct 28 from the adjustments that we are making. So we are going to deduct the less the exchange loss which has been incorrectly added. So what was the amount of the exchange loss incorrectly added? 28. So we're going to add it back. Simran is saying, so can you slow down for this part only? Okay, Simran, I'm slowing down. So we are actually adding the value of 28. Okay, so Murtaza is saying that this should be deducted by 28. Someone is saying that why are they actually doing, sir? I don't get for 28. Tracy is saying that we should less the value of 28. Okay, sorry, this is add. This is add. Abdullah is saying why we are adding 28, but your statements was less. Okay, let me clear this again. And sir, so if the exchange loss is supported to go to OCI, how will this affect the CFI? Okay, let me clear this basically. Let me clear this. Going down. Now what happens that exchange loss is something which has been taken to the OCI. Exchange gain or loss on a foreign subsidiary is taken to the OCI, and this loss would have been deducted from the OCI. This loss would have been deducted from the OCI. So what happens is that when we prepare the cash flow statements, this 28 has no impact on the cash flow statements. So this has no impact on the cash flow statements. So what the question has mistakenly done, the question says that the statement of cash flows showed a loss of 28 million in the net cash generated from operating activities. So showed a loss of 28 million means they have deducted 28 million. So we are going to add it back. The question says that they have shown a loss of 28 million. So this means that they would have deducted 28. So that is why we are going to add it back in the answer. Getting the point, all of you? Murtaza has got the point. Okay, everyone else has also got the point. Harsh is saying it is because the loss is still unrealized, so it won't affect the cash flow. Exactly, Harsh. We have got the point. Someone is saying so 28 is in operating activities. So basically, Simran, this was not a part of operating activities, but the question has mistakenly added, mistakenly deducted from the CFO operating activity. So we are now adding it back. So the entire treatment is based on this statement. I am removing the rest of the underlines. This is based on this showed a loss of 28 million in the net cash generated from the operating activities. So because the question has deducted 28, so we need to add back the 28 to eliminate the impact. Okay, so now let's move further. Bride is saying because the 28 is supposed to go to OCI, not PN. Exactly, Bride, you are right. Simran is saying, sir, hope we can have the same cash flow of thought as you in the exam. Simran, the exam is going to be different. It is not going to be exactly the same that we will be solving. But the thing which is important is the concepts. Gain the concepts, how I'm taking out the information from the question, and now how I'm incorporating that into my answer. So we have to learn the process. This is something very important. Now let's read adjustment number 4, where the question says that during the year to 31st August 2008, David made exceptional contribution to the pension plan assets of $33 million. But the statement of cash flows had not recorded the cash tax benefit of $6 million. So the statement has not recorded the cash tax benefit of 6 million. This is the most important statement of this part, that but the statement of cash flows is not recorded the cash tax benefit of $6 million. So is this an inflow or an outflow? Yes, Simran, this is IS 19. Harsh is saying inflow, George is saying inflow, Mohammad Saad is saying inflow. Yes, a lot of inflows. Yes, it is exactly an inflow, which is not included. So what we are going to do, we are going to include this inflow and we're going to write add the cash tax benefit, which is going to be $6 million. So this adjustment was comparatively an easier one. Simran is saying, so why is it included in the operating activities? Simran, because tax is a part of operating activities. The interest paid, the tax paid, the tax refunds that we receive, all of these are part of operating activities. Okay, so let's back to the question. Now the question further says that in adjustment 5 that additionally David had capitalized interest paid of $25 million into the property plant equipment, out of which 18 million related to property plant equipment and 7 million was relating to the inventory. So we have paid interest of 25, out of which 18 relates to the PPE and 7 relates to the inventory. So is this 7 million of the interest paid an operating activity or a financing or an investing activity? The question say that David has capitalized the interest of 25 into the property plant equipment, and out of it 18 million was added in the PP and 7 million to the inventory. So is there any cash flow issue in this? So this is basically something that is relevant to the APMs and not a part of the cash flow. So we are not going to do anything in this case. Now the last part is going to be part number 6. Okay, so part 6 says that David has a defined. In fact, this is also relating to the APMs. So there's no need to study this as well. So part 5 and 6 was actually APMs. So that is why we do not need to incorporate that into the cash flow statements. So now if we calculate the total of our values, we're going to add 278 plus 30 minus 12 minus 4 plus 28 plus 6. We're going to get a value in total of 326. Okay, there's one thing that we need to check, and let me show you this thing which we have done a mistake. That in adjustment number 5, the question says that additionally David had capitalized the interest paid of 25 million into the property plant equipment of 18 and inventory of 7. But if I go to the question, The question shows an interest paid being adjusted to the cash flow from operating activities. In the operating activities, the question is showing the entire amount of 25. So is this right or wrong? Is this right or wrong? This is wrong. What was the correct value that should have been deducted? Yes, Harsh is right. We should be deducting only the 7 which relates to the inventory. This should be only 7 which relates to the inventory. So what we are going to do, instead of 25, this should have been 7. So what we can do is we can add back the interest paid which has actually been capitalized. So out of 25, 7 should have been included. So we are going to remove the impact of 18. Instead of 25, the correct value should have been 7. So we are going to reverse 18. So we are going to reverse 18. So the question had actually deducted 25. So in the reversal, we are going to add 20, 18. The question had deducted 25. So we are going to add back 18. Simran is saying, so why only 7 included? Why we don't include interest on PPE? Simran, basically the reason is that, let me tell you, going down, that we have paid an interest of 25. So bank would have been credited by 25. And we have debited the property, plant, equipment by 18. And we have debited the inventory by 7. This is the entry that would have been prepared. Now this 18 is basically a cash flow from investing activities. So this should not be recorded as a cash outflow in the operating activities. And the $7 million is basically the cash flow from operating activities. So in the cash flow from operating activities, 7 should have been deducted. But what has the question done? The question has deducted 25. So what we need to do is we need to add back 18 so that it becomes a negative 7. Okay, someone has got the point. So that is why we are adding back the 18. So if I go back upwards, now we can calculate the values again. So 278 plus 30 minus 12 minus 4 plus 28 plus 6 plus 18 is going to give us a value of 344. Thank you, Harsh. So this was the answer to the question where the requirement was an adjusted statement of net cash generated from the operating activities to correct any errors above. So we have got only 4 marks for a lot of effort. If we see the effort was too much, too high, and we have approximately incorporated how many impacts? 1, 2, 3, 4, 5, and then 6. So six technical points where we have to read them, where we have to understand the incorrect treatment, where we have to understand what would have been the correct treatment, and then to correcting all those have given us 4 marks. But this is how the exam is. But this is how the exam is. That we have to solve everything, and that might result in very low marks as well. Simran is very sad on only 4 marks. So Mohammad Rayan is saying, how can we understand that it is relating to APM? Actually, Mohammad Rayan, we haven't studied the APMs. Once we study the APM, then we will be able to understand what is relevant to it and what is not relevant to it. Once we are done with the APMs, then we will be in a better position to understand what values are going to be relevant to that. Simran, we will be studying the APMs tomorrow. So in tomorrow's class, the target is going to be ethics. After completing ethics, we will be moving towards the APMs. And if we are not able to complete the APMs tomorrow, we will continue it on the next day. Now we are not completed with the question yet because we have a 5 marks theory element as well. And we have 8 minutes left also. And the admin is asking for a feedback. So you have quickly 2 minutes to provide the feedback. 2 minutes to provide the feedback for today's session. Okay, thank you everyone for the feedback. So Gail is saying just a quick one from the previous webinar. Were you saying that a subsidiary acquired during the year is not a part of the syllabus? No, Gail. I have said that the subsidiary will not issue new shares during the year in our course. The subsidiary is not going to issue new shares in our course. Okay, thank you everyone for the feedback. And I really enjoy looking at your feedbacks. So that basically motivates me more and increases the energy. Okay, thank you, Muhammad Amin. So now let's write down the part 3 where the question is saying an explanation of the adjustments made in part 1 and 2 above. So what were part 1 and 2? Part 1 was basically one relating to the cars, and 2 is the one relating to the associate. So we need to write the answer to these parts as well. So let's write down the theoretical part. We are writing question 4 by the name of David, which is September 2018 attempt exam. And this is part which? Part B. Question 4, part B, David, September 2018. So what we are doing, we are giving the explanation. The requirements is very important. Read the exact wordings that what do we have to do. Explanation of the adjustments. So we need to write that why we are making such sort of adjustments. So in part 1, we have seen that the cars were basically a property, plant, equipment which have been transferred to the inventory. So we are going to write in case where an entity provides the assets on operating lease, it is treated as a part of IES 16, property, plant, and equipment. Only in case of properties, it is treated in IES 40. So the treatment of David is correct. And after these, in fact, we can directly write it to the case specific as well. In case, in this case, David is providing the cars on operating lease, which should be treated as a part of IS 16 property, plant and equipment. So we do not need this statement now because we have converted the answer into a case specific one. And after these have been available for sale, these become a part of IS2 inventory, which is completely correct. So we have mentioned that what is the correct treatment up till now and what is going to be wrong and why it is going to be wrong. So now we have 2 minutes only left and the admin is informing me to wrap up as ASAP. So let's quickly write it down. I will be writing the answer to part one and you have to try part two on your own. And what you can do is you can send me the written answers on my email address so that I can mark it and provide it to you people. So you can basically send me on my email address. It's HAMZA ABDUL HAQ @hotmail. So write down the answer to the second part and send it to me on the email. I will reply to you with any corrections required. So I'm writing part one quickly. We have very few minutes left. Yes, part two is APMs. So we are going to say that the treatment, in fact, when the cars are sold, it should be treated as an operating activity as the cars are now a part of inventory and not a part of property, plant, and equipment. Therefore, the proceeds of $30 million received should be included in the cash flow from operating activities, which have been incorrectly included by David in the investing activities. So this is the explanation of the adjustment that we are doing, that why we should be including the $30 million into the operating activities. So the reason behind this is also very important. So the time's up for today and admin is always on time. At 10:30 I get a message that time's up. So thank you everyone. Thank you for today's session. I hope it was a useful one. The areas that we have discussed were a comparatively difficult ones, but I enjoy teaching you people, and the replies that you people do really motivates me. So thank you everyone. Looking forward to meet you all in tomorrow's session with the new areas of the additional performance measures and ethics. So see you all tomorrow. Take care and Allah Hafiz.